How did the markets respond for the first few days of trading?
Yeah, so it's been kind of interesting because what we've seen is the bond markets, interest rates are falling, which is usually a sign that the bond markets are saying a recession is coming or a slowdown is coming. And sometimes that means the equity markets fall as well because earnings will fall. But so far this week, we've been kind of flat on the equity markets.
It looks like the Fed is finally getting the data that it wants to see.
If the Fed's looking at this data, yeah. So if we look at some of the data, and the reason that the bond market is getting nervous about the strength of the economy, this week we've had real retail spending, and so the real retail spending is starting to fall, which means people are starting to obviously look at their balance sheets, they're looking at their bank accounts and starting to really struggle to keep spending the way they had. If we look at PMIs, which is surveys of companies, manufacturers have been shrinking for months and they're getting even more shrinking. And if you look at the services sector, it had been holding the economy up, but it's starting to get close to contraction territory too. If you look at the labor market, some of the new jobs numbers, weaker than they had been. Even things like quit rates, you're getting a lot of people that are nervous now to quit, which means they're obviously a bit more nervous that they're going to land a new job if they do quit. So a lot less confidence in the labor market. And I guess the last data point, which has kind of got some good news to it too, is the PCE inflation, which is what the Fed likes, is starting to come down quite quickly, at least the headline number. And so inflation's coming down, which helps the Fed not raise rates as well.
How are the banks doing?
Yeah, I mean, it's obviously a pretty fast-moving data point. We're getting a lot of new charts every single day. There's a couple of interesting charts that have come out recently. One looks at the rapid withdrawals from the small banks, and you can see in the chart just how dramatic and how quick the deposits fell out of those banks, which is really what caused the crisis. So if you're a bank, you get money in as a deposit and you loan it out, you can't necessarily call the loan to pay the deposit back really quickly, and that's kind of what happened to the banks. They all got the deposits coming out and they didn't have enough liquid assets to meet the deposits. Having said that, there's more data coming out on the emergency facilities that the Fed really quickly implemented, and they were used dramatically very quickly. And although the mix of those two facilities has changed, they haven't increased in their use, and it's actually maybe slightly down. So that would indicate that the bank's managements aren't seeing more runs on deposits, which allows them to sort of pull back and go back to more normal banking.
Always comes back to liquidity, doesn't it, right?
Yeah.
And we also have to pay attention to credit conditions as well.
Yeah, so talking about the bank crisis, I mean, one of the interesting things is we've obviously seen interest rates go up. That makes it harder for people to borrow. But the credit crisis or the banking crisis probably makes it harder for banks to want to lend as well. So that tightens credit conditions, makes it harder for companies to get loans. And typically when you see all of that happen, companies don't hire as many people or they start to actually let people go. And so often when all of that happens, you start to lead into recession or a slowdown as well. So some of what the Fed needs to happen might actually be helped by the banking crisis.
So then the obvious question is, do you think there's any change to the Fed's calculus? I mean, they haven't articulated that's the case, and a couple of data points doesn't necessarily mean a strategy shift, but what are you hearing, what are you seeing in terms of Fed funds rates and where they think it might go in May?
Yeah, so the bond market obviously thinks the Fed's listening because the bond market has completely repriced the interest rate curve from a peak of interest rates pushed by the Fed to 5.5%, 5 3/4, down to pretty quick reductions in interest rates already later this year. And even the Fed, a lot of the speeches that the governors had done had said, maybe we'd do 50 basis points a couple of weeks ago, and they did 25. So I think the Fed's aware, they're watching everything, and the market thinks the Fed is going to get pretty close to peak rates now and maybe be cutting, which would be, or at least remove a headwind for stocks.
All right, appreciate the insight, Phil. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.